welcome to the Professional Hub by MME. I'm here today with Kharen Kaleda. She's from Avant-Garde Business Services. And they're an accounting and financial advice business. So Kharen is one of our experts that we're featuring. It's coming up to the end of financial year, so very appropriate that we talk to her now. So Kharen's got 30 years experience in providing business advice, taxation and accounting services to a really varied range of small and medium businesses. As I said before, she's a chartered accountant and she's the owner of Avant-Garde Business Services. Kharen works with businesses to be more efficient and ready for growth. So her and her team focus on getting the appropriate business structures in place, then streamlining the accounting processes through cloud accounting software, and then tax planning. This is all alongside the traditional preparation of financial reports and tax returns. So thanks for joining us today, Kharen.
You're welcome.
All right. So, well, if we want to get started, so basically, it is the end of financial year. Let's talk about tax planning. Certainly businesses are thinking, what can we do to minimize our tax, particularly if they've been struggling through this period. So what are some of the tips that you might have on, some strategies you might put in place to minimize your tax?
Okay, before we get to any strategies to minimize tax, I'd just like to say that paying tax isn't always such a bad thing. So people try to get their tax down to nothing, but paying tax means you made money. So particularly in small businesses, you only pay 27.5% tax in a company. So you can make $1,000, pay $275 in tax and keep the rest for your business to grow in later years, or to pay to yourself as an owner as a dividend. So paying tax isn't necessarily a bad thing. I'd love to pay $1 million tax. It would mean I'd made $3.5 million, which would be sensational. So there are strategies, though, to get that down and still grow your business rather than just spending the money for the sake of saving the tax, because you have to spend the whole $1,000 to save the $275. So a good place to start is maximizing your super contributions. All individuals are restricted to having 25,000 as a maximum they can put into super. And why this is a good idea is that when the money goes into super, it's taxed at 15%, but it saves the company tax at the 27.5%. If you're a sole trader or in a partnership, trust, or just an individual, you save that tax at your marginal tax rate. So that could be as much as 47% saving, and you still may only be paying 15% on the way in.
Okay, well, that makes a big difference, doesn't it? Are there any thresholds that you need to worry about there?
Yeah, so it's not worth putting money into super if you're not paying tax, except for the benefit of having the money in retirement. So you have to look at what the individual's tax rate's going to be before you do that. Then there's also upper limits, because your super can be taxed at 30% going in if you're one of those high income earners. Also, this year you can put money into super and claim a tax deduction as an individual or an employee, even if your employer is putting super money away for you. You just have to be careful that what the employer has put away plus what you're putting in doesn't exceed the 25,000.
Right. Okay. And there's the Medicare levy as well, isn't there? There's reductions in that if you choose to put into super, is that right?
Yeah. So when I said up to 47%, that's 45% tax plus 2% Medicare levy. So yeah.
Right. Okay. So what else can we do? So there's the superannuation. What other things can we do pre-30 June to minimise our tax for the year?
So in normal years, you can buy any equipment up to $30,000 and have an immediate deduction if you're a small business. This year with COVID, they've increased that to 150,000 that you can write off immediately if your turnover is less than 500 million. So that's
Okay, most of it.
all businesses, yeah, to be talking to. So that was up till the 30th of June. That's now been extended to the end of this calendar year. So if you need equipment, if you need a new car, don't go buying something that isn't going to be beneficial to your business just to save the tax. But if you're in need of that sometime in the coming year, buy it before 30 June and you can claim the tax deduction in this year.
Yeah, okay. I think you were talking to us about the cash and accruals.
Yes.
What options there?
So depending on whether your tax return is lodged on a cash basis or an accruals basis, you can do a few things prior to 30 June that helps you there as well. So if you're on a cash basis, which most small businesses are, that means that you're not paying tax in this year on any money that your customers or clients owe to the business. So if you haven't received the money, you don't pay tax on it. But the same can be said of any money you owe to your creditors. So if you haven't literally paid the creditors, just because you have an invoice from them doesn't make it tax deductible.
Right, but it would do if you were on the accruals basis.
Yes, exactly. So if you're on the accruals basis, you can order any sort of stuff that you want unless you're on stock, and then it goes to the balance sheet. So bringing the expenses forward on the accruals basis helps. But most clients being on a cash basis, just because you've put it into your profit and loss in your software doesn't mean it's tax deductible. Go through all the list of anyone that you owe money to and pay it before 30 June to get that deduction in this year.
Yeah, absolutely. And I think, there are definitely benefits for that cash and accruals basis. Certainly with our business, feeling the pinch over the last few months and perhaps, huge revenue drops, but we have still got money driven from, creditors. So that's the debtors, I mean. And so, that can make it tricky to minimize your tax.
Yeah, it may look on paper like a good year, but if people haven't paid you, there may not be a lot of tax that's payable this year.
Yeah, okay. The depreciation schedule. So this is something that completely baffles me. Depreciation. That's why we employ, business services and accountants like yourself. So, what benefits with the depreciation schedule?
So you used to only be able to claim as an immediate deduction the first $1,000. Not the first, anything under $1,000. Right. In value. So all of those larger items were depreciated. Some businesses use a pool, so that's a completely different situation. But if you have each of your fixed assets listed on your depreciation schedule, then depending on what type of asset that is, the tax office determines how much you can claim in each year. So it spreads the deductions over large items over a number of years. What we find is that some clients don't regularly look at the depreciation schedule and say in this time of working from home may have replaced a computer and scrapped the old one. If the old computer isn't fully written off, then it's going to be claimed over the next couple of years. But any assets that were literally scrapped or thrown out, if there's a remaining balance on those, you can write them off now and get the tax deduction for that balance.
Oh, okay. All right. Well, that's a good idea.
Yeah, so running your eye over your depreciation schedule, saying, do I still have all of this? Do I still use all this in the business?
Right. Yep. Okay. Well, that's a good one. I hadn't thought of that one, and I'm sure that yes, you're right. Working from home, everyone's got new stuff. So okay. And does that sort of transfer across to the personal side of things as well, as a sort of a business owner and you know, somebody who can write off your own working from home expenses?
Well, the working from home expenses is a whole nother issue for this tax year. And the tax office has come out with 3 different methods for calculating your working from home claim. In the past, you could claim 52 cents per hour for electricity and other simple sort of items working from home, or you could add up the actual cost of working from home, like the increase in your electricity bills. So you'd have to have very good records, actual ink and the percentage use on the internet and home telephone, those sort of things. So you can go with the actual method where you have to document it very well. You can go with the 52 cents plus a few extra items, or there's an all-encompassing 80 cents per hour that's the full claim.
Right. Okay. And what about?
It's very simple.
Yeah, and then what about your sort of the staff costs as well? Because sometimes you're paying for your staff internet and you know their mobile phone expenses to conduct work from home. Does that are they claiming that, or you know what?
If you're paying it in your business, it can't be claimed by both.
Right.
So if your employer's paying for you, you can't claim as well, but they may pay it to you as an allowance, which means it comes through as income on your tax return, then you have to claim it as a deduction to wipe out that income.
Right.
So there's a lot of ifs and buts with all of that, but that's the basis. There's new things because of COVID, the 80-cent rule, which I think a lot of people will take advantage of because it will just be an easy method.
Yes.
Employers could pay their employees the 80 cents and then the employees could claim it back as well if they wanted. But if you're directly paying invoices for your employees, such as their internet, then that's just claimed in the employer's tax return. And you'd have to be careful that you're not paying all of, say, the internet and then it's being used by the rest of the household for their Netflix and everything else, because then it could become a fringe benefit.
Ah, I see, right. Okay, yeah. And it'd be expensive as well. All those Netflix.
I wouldn't imagine there were any homes that didn't have internet that had to get it in order to work from home. So yeah, you just have to be careful that you're not paying more than this is costing the employee.
Yeah, okay. Okay, so anything else that you sort of can think of that we can do to really take advantage of these next couple of weeks tax-wise?
Something else to do is to review your accounts receivable, so people owing you money. If there's anything on there that you know you're never going to get paid for, you've tried to chase it before, you're going to stop chasing that money and you know that you'll never get paid, you should be writing that off. So that becomes a bad debt. If you're on a cash basis, it won't affect the tax in this year. but it does clean up your accounts. And if you're on an accruals basis, you've already paid tax on that money that you're never going to receive. So writing it off in this year will reduce this year's tax.
Right, okay. Yeah, so
hopefully people don't have that problem, but they
no,
are.
there's certainly, you know, maybe a company's paying in dribs and drabs, and you know, perhaps there's a bit of an outstanding balance, but it wouldn't make any difference if you're on a cash basis to write that off until you're sure that they've yeah.
Absolutely. And there is a rule with the tax office that if you're writing that off, you can't keep chasing it.
Right.
So make sure that if it does turn up in years to come for whatever reason, then great, and it becomes income again. But you strictly shouldn't be chasing the money once you've written it off.
Yeah. Okay.
Get a little more technical with you. The company tax rate this year is 27.5%. That's set to fall to 26 next year, and then 25% in 2021-22 financial year. So when a company makes profits and it pays its tax on its profits, that's called retained earnings. So the company is worth more and more each year as it keeps that money within the entity. The only way to get that back out is to pay dividends. So dividends come with a credit for the tax that the company's already paid, and then the individual just has to pay the increase to their marginal tax rate, or if their marginal tax rate's less than the company tax rate, they'll get a refund. That's under the current legislation, and that's what the Labor government wanted to remove, the refunding of franking credits. So as the tax rate falls, you'll get less credit in coming years for the money you've already paid, right? If that makes sense. So if you're going to pay a dividend out over the next couple of years, you're better to do it in this year.
Right. Okay.
Makes sense?
So, it does look, it makes sense that you're telling us to pay it this year. So that, you know, I might not understand why, but certainly.
Yeah, you get a better tax credit to pay your personal tax. So this only applies to companies, and it's in this year. Ideally, if you don't need the money personally, so if you've paid off your mortgage and all that, you don't need to get access to the money. The best idea is to keep those profits until you retire. So then your income drops right down and you can pay yourself a franked dividend for a number of years.
Sure. And
either have an income that's tax-free, or if the legislation still remains, you could get a refund of the credits you've paid in the past.
Okay. Okay, yeah, that's good advice. Thank you. Thank you. Well, look, I think, you know, certainly there's probably more intricacies, and this is very general advice, and depending on what your business, you know, needs are, please reach out to Kharen. She's available. She's busy, but she's available, and she's, you know, I think one of the things that Avant-Garde, you know, they're different to other businesses because, you know, they're proactive. You know, if you think about those businesses that wanted to take up the job, you know, a lot of us were in a situation where we had to figure out ourselves whether we needed that, whether we were eligible for it. You know, Kharen's team had already done that. She'd got a list of all her companies, all clients, and determined whether or not they're eligible, and then pretty much went through the process for them. So you know, that's the type of service that you're getting. So please do reach out if you need any advice. And you know, and we'll also be talking about improving cash flow in the next episode. So it was lovely to see you again, Kharen. Thank you for your advice and all your strategies. They're great. We'll also put in visual format so that you can actually see it and kind of read through some of the things that you can do, and we'll add that to the Professional Hub by MME. And we'll see you next time. Thanks, Kharen.
Thanks.
Cheers. Bye.